type of debt mutual funds. As equity funds primarily invest in stocks, debt funds primarily invest in fixed income securities like bonds, T-bills, government securities, etc. Debt funds are also known as income fund. Return on debt funds is primarily from the interest earned from the fixed income securities of debt fund portfolio. Debt funds are more suitable for investors who want to invest in mutual funds but not in equity fund. There are many types of debt funds. Some of them are as below. Diversified debt funds. In this type of funds, fund manager invests in a mix of government and non-government securities. There are many types of fixed income securities in which the fund manager can decide to invest. Some of the securities in which investments are primarily made are corporate bonds, commercial paper, debenture, etc. Here also the purpose is to diversify the risk. Though risk in debt funds are less, but by having diversified debt fund, it invests in different type of debt so that risks are diversified. Gilt fund. Gilt funds are the type of debt fund which invest primarily in government securities like T-bill. The term gilt was originated from Britain to represent the bond issued by the British government. Since investments are made into government securities, we can consider gilt funds as most secure debt funds having minimal risk of default. But if there is a minimal risk, then returns are also accordingly. Then comes money market fund. Money market funds are those funds in which investments are made into debt securities having short maturity period. As per regulation, this scheme can invest in debt securities in which the money will be repaid within 91 days. Since the investments are made into securities having short maturity period, this debt fund is recognized as the lowest in risk among other funds. Fixed maturity plan. Fixed maturity plans are closed-ended schemes with a fixed maturity date. Investments under fixed maturity plans are mainly made into the debt instruments issued by corporates. Investments are made in such a way that debt securities maturity coincides with the maturity of fixed maturity plan. Here it is important to understand that if retail investor wants to invest in different bond, then due to their large size, it may not possible for them to invest directly. So the best way is through mutual fund route. Floating rate funds. In this kind of debt fund, interest rates are not fixed. Fund manager largely invest in floating rate debt securities. So though debt funds are less riskier than equity fund, but within debt fund also it is possible to diversify the risk by making investment in diversified debt fund.